Welcome to the show. This is the Willpower Podcast, hosted by Will Holdren. Each week, we sit down with the brightest entrepreneurial minds and uncover the real secrets behind their success. And if you want every episode in one place, plus exclusive insights and updates, head to willpowerpodcast.org and join the email list. If you're ready to take that next step and unlock your next breakthrough, you're in the right place. Now, let's get to the show.
How we doing, everyone? My name is Will Holdren. I am the host of the Willpower Podcast. Today, our featured guest is Mr. Scott Carson out of the Texas area. And Scott was in the mortgage world, and he left that in 2008, and then he transitioned into real estate. He found his niche in the note business, eventually flipping notes. And he's the founder of the Note Closer Show podcast, and has been featured in several major news outlets, such as the Wall Street Journal. So excited to have him on. He's also facilitated over $1 billion in distressed debt, which is a astronomical number. So with that being said, Scott, thank you so much for joining us today.
Glad to be here, Will. Yeah, I'm kind of known as the note guy across the country because we've closed on a lot of distressed debt for our own portfolio, and then also helped a lot of investors tap into what I call the sexy side of real estate, or becoming the lien lord instead of the landlord.
Right. Yeah, you guys have been around the block and seen a few things.
Just a little bit, yeah.
Yeah. Starting out, though, I'm going to ask you a question I ask all of my guests, which is what makes you want to take time out of your busy day to hop on podcasts like these to share your story?
Well, I'm a big believer that podcasting is the number one, I'd say, stage to get the word out and educate people out there. And especially in my niche of buying debt, there's a lot of misconceptions out there when it comes to what a note is and how do you buy a note, and do you own the real estate to go along with it. So it always gives me an opportunity to kind of share the specifics of what it is and really spread my message to international audience, not just domestic. But I've always been a big believer, if even just one person hears what I'm talking about and I touch that one person, it's worth my time.
Yeah.
And so I just think it's a great way for two hosts to network together, get to know each other a little bit, but then also spread the word to our audience and really help those people that are either watching or listening or who end up reading this as a blog at some point.
Yeah, I love that. It's a really great mindset. Starting off with your journey, you kind of have an interesting story. I mean, you were in the mortgage world in 2008, and then you decided, I'm going to stay in the real estate world even after that crash, which is kind of interesting to me. But so walk me through what was going on in 2008 for you at that point of time, and you're in the mortgage world. But then, kind of walk me through what happened around that time period.
Well, so 2008 was definitely an interesting time for a lot of people. When the music stopped, the carousel stopped for the mortgage. But you have to kind of take it back 6 years before that, when I bought my first house here in Central Texas and Round Rock, Texas. About 6 months later, I got laid off from my job, and I was a distressed borrower, trying to save that house. And then I'd also bought 2 investment properties, traditionally paying through the nose for them. And my tenants got laid off from their job as well. So I was trying to make 6 mortgage payments on my ex-wife's, or current ex-wife, private school teacher salary, which doesn't work very well.
Right.
Fortunate for me, I was able to get my ass out of a sling, got rid of the 2 investment properties, was able to modify my loan and lick my wounds for a couple of years. And then along came a buddy of mine, Boyd, in 2004. And he was starting a mortgage company with a couple of real estate investors here locally who were traveling the country, speaking on creative financing and real estate investing and creating notes or note investing. So it was an opportunity. I was like, oh, wow, this is really something I want to do. So I left my job then, because I'd gotten hired back on in banking.
Yeah.
And we started this mortgage company together and was really successful for 4 years. I really call it an apprenticeship, because not only were we originating loans for real estate investors across the country and speaking in front of thousands of real estate investors, but I also got to hear a lot of other creative strategies, the right way to do real estate investing. And I call it a 4-year apprenticeship leading up to what happened in 2008. So when the mortgage origination business stopped because of the crash, I saw an opportunity to get out of the origination side and get into the de-origination side by buying notes and getting these lists from banks and diving headfirst into being a real estate investor. And I did a lot of what a lot of real estate investors do. They dabbled in a bunch of different things for 2 years. And then in 2010, I really just went 100% into the note space. And that's really what I've been doing for the last basically, as we say, 16 years nonstop. You're just buying notes for the most part. So
That's amazing.
that's kind of what led into it. I had this amazing apprenticeship that few people had, and I just took the knowledge that I learned from my mentors, Bob Leonetti, Jamie Kayla, Ron LeGrand, and took it and then ran off with my own.
Yeah, I think that's a pretty amazing story, and a lot of real estate investors I think go through to your point, like you said, a few years. You're kind of trying to find your niche, and to me, I think you kind of find your niche based on the people that you're around and what they're doing that's successful, and then that kind of becomes your niche, right? So for you, it's going into the creative finance space and buying notes. So I think is a really interesting strategy. Before we get into that, though, you mentioned that you were had to pay 6 loans at once, pretty much at when you lost your job, and '08 happened. So did you ever lose confidence in like the real estate industry, like over those time periods? And
Of course,
yeah,
man. When you get your teeth kicked in, the last thing you want to do is take another bite of it, right?
yeah, yeah, yeah,
I think the only person that made any money in those 3 deals was the realtor. And we bought her primary, and then she came to me like, you guys got great credit scores, a great time to buy. And I was like a little too confident. I mean, I grew up in a small town. My parents owned the local hardware store, so my whole idea was like, oh, I'll be the new landlord. I can fix anything, and
right,
lo and behold, that didn't work out well. So yeah, it took me a while, not only to lick my wounds, but to get my ass out of a sling. I mean, we were
yeah,
behind on payments and stuff like that, so it took a while to kind of build confidence. And I knew that don't get me wrong, I was a great banker, one of the best bankers for J.P. Morgan Chase here in the state. But it was like I was hitting that ceiling. They wanted to move me into positions that I didn't want to move into. I didn't like what those people were doing as far as their quality of life, and
yeah,
realized I wanted to do something different. And I've always had an entrepreneurial bug. And
yeah,
so when Boyd called me back up, he's like, "Hey, I got this. We're starting this mortgage company." I went to lunch with him. I was like, "I'm willing to take the risk. I can always go back to banking, right? I can
right,
always go back to a job, and let's give this a try." And
yeah,
it's been a fun 16 years.
yeah, and you never look back.
Yeah, yeah.
I think there's probably a lot of people listening to this podcast that kind of have that fear of going through those events that you went through. And I think you're really a testament that you can still come out on the other side and still find a way to make it happen. So what would you say to people that just have that innate fear of like a property not working out or getting real estate and just, seems scary starting out?
Well, everything seems scary when something new. Going on a first date is scary when you're a kid. Going in for your
Right.
first kiss, your first dance, all that. Driving the car for the first time is all scary. And what is it? The fear is just stands for false evidence appearing real.
Right.
If you're scared or nervous about something, the first thing you got to do is get out and network with people that are doing the things that you would like to be doing. And that's why your local real estate clubs, your networking events, that's the first real step. Get around different people instead of the people that are around you that haven't done or aren't where you want to go or aren't doing the things. They're going to try to protect you because they don't know.
Right.
But surround yourself with people who are closing deals and doing the things that you want to do. That's the first thing. The second thing is you need to get educated, taking a class, hiring a mentor, somebody who's still doing deals in today's market. Don't hire somebody who hasn't done a deal in years. That's a waste of money. And
Yeah.
then third thing is then find a deal that you can pull the trigger on. It doesn't have to be a big deal. I mean, if you don't have your own money, that's always one of the contributing factors to people being scared of because they don't have the funds or retirement accounts. Go talk to IRA investors, go talk to other investors to partner with on a deal here locally or wherever you're at. Those are the things that will help you overcome that fear. And
Yeah.
you'll learn more by doing your first deal than any type of class or workshop or things like that. But you need that foundation to avoid stepping into potholes or tripping over hurdles along the way.
Yeah. And I think a lot of growth comes from taking scary actionable steps, right? And a lot of things that are good for you for growth, it's scary starting out to your point, and you just got to take that leap of faith. Um, so getting into your niche, so walk me through again, how did you get into the creative finance space? How did you kind of learn about this? And yeah, kind of walk me through that setup.
So when we were at the mortgage company in 2004, 2000, there was about 4 of us that sat in a house that was 2 bedrooms with a wall knocked down. All right. And Boyd and my buddy Boyd and I were originating loans traditionally through bank loans, stuff like that. And the other side of the room, Bob, Jamie, and another guy, Rob, were originating owner finance notes, getting creative. So, like I said, for 4 years, I kind of had this apprenticeship on the origination side, but also listening to the creative finance side. So that about 2 years into that, I was helping create structure deals, helping people put something in and get things done. Take a square peg and fit into a round hole in a lot of cases.
Yeah.
And then when everything hit the fan in 2010, I stopped originating, but it led to the opportunity that not only my mentor Bob, but also another mentor of mine came to me and said, listen, this is a great time. All this distressed debt is out there. We haven't seen it like this since the 80s with the Resolution Trust Corporation or the savings and loan scandals. Now is a great time to be buying debt. And so that's what I did. Instead of originating loans, I started calling the banks, one at a time, 50 phone calls a day. Hey, what kind of bad notes do you have on your books that you want to get rid of? Where somebody hasn't paid their mortgage in, 6 months or longer. And I started getting banks to send me these lists of naughty notes, non-performing notes that I could cherry pick from. And that's what I started doing. I was like, oh, this one property in Jacksonville, it's worth 75 grand. The borrower owes 80. I can pick it up for 6 grand. You know what? 6 grand. And then I could get either the borrower back on track and make a 20% return. If they don't play ball, I'm the bank. I have the right to foreclose. They still owe the full amount. I'm gonna do pretty good if I sell it at auction or take it back as a foreclosure. So I started getting these lists in that nobody else was seeing 6 to 12 months ahead of most real estate investors. I wasn't having to drop thousands of dollars on postcards or yellow letters or direct mail campaigns to get these deals sent to me that I was only one of like a dozen people that was seeing this stuff. And so I just started marketing, and that's what led me to start teaching, was talking about the difference between buying a note versus buying a property. And so that's what just kind of happened from 2008 to 2010 and beyond. I was just dialing for dollars, making 30 to 50 phone calls a day, 3 to 4 times a week to get these lists sent to me. And we started flipping a few, wholesaling a few, taking a few back and for my own portfolio. And we've just gone from there.
Interesting. So you guys are really just calling up the banks, and the banks are able to send you guys these lists and these properties that are distressed debt. I mean, they're not in foreclosure yet, but they're headed that direction. And so are you pretty much coming in, calling these home buyers and saying, let me take over your bank loan? And then that's
No. I don't want to own their real estate.
Yeah.
So I'm literally just don't think of me as Scott Carson, no investor. Think of me as Scott Carson, the bank.
Gotcha.
Okay. So like if you ever bought a house and you get a mortgage on it, about 30 days after you close, you get a letter in the mail that your mortgage has been sold to somebody, right? You got to start paying somebody else. Well, that's the same thing. I'm buying that debt from one bank or one lender at a big discount and literally becoming the lender. And we're not calling the borrowers to take over their mortgage. We're calling the borrowers who haven't paid to get them to start paying on time again, because that then creates cash flow.
So yeah.
And then if they won't pay, I'm the bank. I have all the right in the world to help them modify it, work out, do a short sale, approve a short sale, or foreclose if they won't play ball, or offer my cash to keys to walk away if they can't come to the table and do something.
Gotcha. So you're buying the loans directly from the banks themselves. Yeah, to your point, you're kind of your own bank in that realm. And then that seems to me, so that definitely seems to be a risky strategy when the buyer's already defaulting on these loans, correct? Or
how would it be risky, Will, if I'm buying the note at 50 cents on the dollar of value?
Yeah, I mean, yeah.
Think about that. If most people, they pay full retail for a property. Most, or they buy a rental property, put 20% down there at 80%, and they got to rely on a renter to pay on time. Well, we know that doesn't always happen, right? You got to pay regardless. So if I'm buying that note at 50 cents on the dollar and it's a 6% interest rate, if I get the bar just to start paying on time again, no extra, that's a 12% cash and cash return to me.
Yeah.
If I can have them start making extra payments and getting caught up, that's going to skyrocket my ROI to an 18 to 20% return. If they don't pay and I'm in at 50 cents to the dollar, I'll foreclose. If it's worth 100, I'll tell the bank to sell it at auction for 80, and I make 30% within 6 months to a year. So that makes you'll go up. Of course, if it doesn't sell at auction, now I take the property back, fix it up, and sell it as an REO.
Yeah. So who's the one taking the loss in that? Is that the bank taking the loss on that mortgage initially, and they're okay, I guess, with that because that's probably the best case scenario for them at that point?
They've written off that loan. They've taken it off their books. Because here's the thing you got to realize. When you originate a loan, especially for a lender, you have to keep so much cash back in reserves, right? And the way that banks leverage money at 15 to 50 times for every dollar that's in their account, if they've got a loan that's now 90 days in default, they've got to pull money off that they can't lend out 10 to 20 times that are making fees on. That one loan, that $100,000 loan may cost them $1 million in fees.
Wow.
All right, because they can't lend that stuff out and rinse and repeat every month on points, or they may get that money at 1%, okay, on a deposit and lend it out at 7-8%, or lend it out in credit cards at 23%.
Gotcha.
So that non-performing loan it clogs up their books. Yeah, they'd rather sell it to me at 50, 60 cents on the dollar and take that loss so they can go out and now originate, make up those fees, and let me take over a foreclosure that maybe 6 to 12 months in a state like like
Yeah.
Florida, which can take over a year. Or you're in Atlanta right now,
Yeah.
Texas, Georgia's fast foreclosure states. A lot of times I'll buy a note and I can foreclose in 60 days if the borrowers won't come to the table.
Gotcha. That's a really interesting. So the banks, yeah, so the banks don't even want to deal with the whole foreclosure process because they have to hold on to a loan for that much time, which is holding up so much extra cash that they could be using to make other loans and generate origination fees somewhere else.
Well,
Correct?
not just origination fees, the arbitrage.
Arbitrage.
The difference in what they're getting the money in at less than 1% borrowers and then lending that money out at 7%. That's not a 6.5% increase. That's a 650% ROI to them.
Yeah. Yeah. Interesting. That's a really unique strategy.
It's
Yeah.
been around for years, man. That's why the banks are the biggest buildings out there. You know what I mean? It's a thing to look at if you ever like watching movies. The Big Short or Margin Call talk about it a lot of cases. Now,
Yeah.
you don't want, I'm not going to buy something that I don't want to take the property back. I'm going to buy something that either A is occupied where I can get the borrower back on track. I don't really want to own the real estate. When you're the bank, nobody calls the bank when the AC stops working. Nobody calls the lender when little Timmy flushes his rubber ducky down the toilet. You know what I mean?
Right.
So in our normal cash flow, at a minimum, we're looking $400 to $500 a month and beyond. Whereas a lot of landlords, renters out there, they're like, oh, I'm getting $200 a month. Well, we all know if you have one hiccup along the way, that $200 a month becomes a negative cash flow pretty quick.
Yeah. Yeah. It's a different perspective of a real estate transaction when
Yeah.
you look at it like that. So what's the risk, I guess, when you're doing a deal like yours? Because I mean, if they pay on it, that's great, and you're making that cash when you talk about. They don't pay on it, you get in foreclosure, you can sell it at a much higher price than what your loan is, and you're making money there. So I guess, yeah, what's the is there any risk in this
Yeah,
kind of
risk
play?
is you've got to have cash. You can't go out and get a loan to buy a note most of the time unless it's like a
So you
commercial
could have that
property.
straightforward cash on hand.
Yeah, so you're using
Right.
other people's money. The other big thing is all due diligence, like anything else. So, you got to make sure the taxes are paid because taxes will wipe you out.
Yeah.
The risk is you don't see the interior of these assets if they're occupied. Okay, but you're buying at a big enough price discount to usually that. Well, if you've got to put paint and carpet in a property, new appliances, you're going to be sitting okay still. For the
Yeah.
most part.
Yeah.
The other thing is somebody dragging out the process. Now, if somebody files bankruptcy, that often for a traditional real estate investor, that's like, oh, well, we're out of the deal. For us, when somebody files bankruptcy, that's a good deal because now we have an attorney to talk to, and
Hmm.
he's either going to turn into a BK Chapter 13 of a 5-year payment plan, or it's going to be a Chapter 7, a liquidation of assets where we take the property back. So it's all about making sure too, like, we're still going to pull property values, drive by the property. This is what we're buying. We're not buying the actual physical asset. We're buying this loan file.
Right.
So reviewing the documents, making sure all the assignments and the documents are created
Right.
properly, disclosures are signed.
Yeah.
That's the thing. Also looking at the servicing notes, the payment history, making sure everything, all the T's are crossed and the I's are dotted. So it's a
Yeah.
different due diligence process. But it's also, I think the number one is never buy a note. You don't want to end up owning the property. Doesn't mean you want to live in the property, but the number one commandment is never buy a note you don't want to own the asset on.
Right. Right. So what do you look at for, I guess, loan to value ranges when you're setting up these separate notes? Because like you mentioned, I mean, properties probably worth a lot more than what the mortgage is at that point.
No, not always, man. We buy a lot of stuff that they're upside down.
Really? Okay.
I actually prefer buying notes where the property is less than what's owed
Interesting.
because that's a negotiation tactic at that point. Now, I'm going
Yeah.
to buy at a percentage of value. I'm not going to go 100. I'm not going to usually go above 70% of loan of investment to value,
Yeah.
right? So, but if somebody's like, I'll give you an example. If the property's worth 100 and they owe 80, well, they've got some equity there, right? They're going to fight you for that equity, and I'm going to have to pay a little bit more because there is equity. So
Right.
on something like that, where there's a chunk of equity, I'm probably going to have to come in at 80 cents on the dollar of the loan balance. Okay. Whereas if they're upside down and they owe more, well, they're in a negative equity position. They're not going to fight you for negative equity, right? They're
Hmm.
much more willing to work with you, get back on a payment plan, and I'm like, listen, bad things happen to good people all the time. And I rely on sharing my story with borrowers. Like, hey, I was once distressed, years ago, and I was able to work something out. Let me help you. If you want to stay, You got to pay. If you're 2 years behind, okay. I mean, I know that's what the other lenders wanted you to bring 2 years to the table. I know you don't have that. Can you bring 4 months to the table and start paying on time and pay a little bit extra? So it
Right.
gives us a lot of creativity um, to be with the borrowers to create a win-win scenario. So that if they start paying on time for 12 months too, it's then considered a reperforming loan. I could turn around and sell that note after 12 months of on-time payments back to Wall Street for 80, 90 cents on the dollar. And
Interesting.
so I've held it for cash flow. I got some lump sum up front, from the bar, bringing it and then paying for 12 months, and then I get a big payday in the back end of selling the note back to Wall Street or back to an investor or something like that as well.
Yeah. How long do you have to wait before you can resell a note? Or is there no?
So it all depends. That's the number. That's the answer to every real estate question, and it all
Yeah.
depends.
Yeah.
Preferably, you want to see 12 months of on-time payments.
Okay.
Okay.
Gotcha.
If somebody brings a big chunk to the table and they reinstate their loan and they've paid on time for 6 months, you can usually probably sell it at a pretty good price to resell it back. The big mistake a lot of people make right now in the market is people sell on owner financing and they think they can turn around and sell that note immediately for full value. That's not the case. It's never been the case. You really need, if you're going to owner finance, you need to make sure and expect to hold that note for a year, but then also structure that note so that it's a sellable note. Making sure you used an RMLO, you've got a down payment, the borrower's got a 620 or greater credit score, and it's an interest rate, appropriate with where the market's at, like 8%. Owner financing at 4 to 5% is only good for the borrower. It's not good for you, the lender.
Yeah. Okay. So you're just talking about how you're talking to the owners and saying, hey, can you pay 4 months? But you're doing the negotiations with the bank to take over the note. So who are you really negotiating? Or are you negotiating with both people when you're kind of
Well,
thinking
you can't talk to, you don't if you don't own the note, you can't talk to the borrower until you
all
own
right,
the
so
note.
you have to get the note first and then you're coming
Buy
to
the note.
the borrower.
But here's the thing, Will, since we're the bank, we get access to all the servicing notes. We get access to the loan collateral file. So we'll see hardship letters. We'll see what the borrower has tried to do with the existing lender. And that gives us a good, idea of what can we do. And then we do our own social media sleuthing and checks like, okay, the borrower lost their job a year ago when they
Yeah.
went, default. We can see if they're working somewhere. We can, see what they're doing on Facebook and LinkedIn. So that gives us the opportunity. I mean, the thing I look at is, when you see these servicing notes and you see a hardship letter where somebody's, sending a letter, hey, I want to try to stay in my house, stuff like that, or somebody's missed payments, they've been hit and miss over the last year, and it's owner occupied, that gives me all the motivation. I mean, like that borrower wants to stay in the house. All
Yeah. They
right.
want to make payments. Yeah.
They want to stay. Most people want to stay. Let's buy that note. And if we can get them paying on time again, and it's a double-digit return just to reinstate the loan, that's a good deal to go with. Now, does everybody always pay on time and stay back on track? No, they don't. If you don't get a little bit of skin in the game on the front end, you're going to see a high default rate. If you get at least 4 months on the front end of like back payments, they're usually going to stay on time for about 85% of the time.
Gotcha. Yes, that's another good point. Well, I mean, what percentage of these notes that you're buying that are in default actually, pan out and the buyers start paying them off, and which ones actually like what percentage actually goes into foreclosure over time?
So it's about a 70-30 ratio. 70% if it's owner occupied,
Yeah.
about 70% of the time we can get them back on track
Really?
with some,
Wow.
yep.
Wow.
Because we know our front end, we know our numbers. You know what I mean? We see, we can see the tea leaves. If they've communicated, they haven't communicated. Of course, if we see that the lender's been reaching out to them and the borrower told them to go pound sand or F off, well, we know we're gonna have to foreclose on that one, right?
Right. Yeah.
But the other 30% of the time is usually a mixture of they can't pay, so we'll negotiate like a deed in lieu of foreclosure where they'll just give us the property back, or a cash for key scenario where we'll give them some money to walk away.
Yeah.
And of course, if they won't play ball, then 15 to 20% of the time, we're going to probably have to foreclose.
Gotcha. How much negotiation does the bank do with you when you're talking about buying off these distressed notes? There's a kind of just this is their number and that's what it is.
Yeah, it varies. They'll send me an Excel spreadsheet. Like I got an Excel spreadsheet the other day from one lender with 54 notes, and then I got another one with 5,400
Wow.
non-performing notes. Okay.
Oh my gosh.
And I can cherry pick these. Most of the time I can cherry pick them, which means I can pick out my favorite ones and submit a bid in. Okay.
Yeah.
So it varies, knowing if they're behind, I'm going to see how many months behind they are, what their full legal balance is. I'll look at quick online values,
Yeah.
and then I'll submit a bid. And if they like my bid, great. Then we go into due diligence. And then in my due diligence, I'm going to check title. I'm going to check the property values by sending by a realtor to pull an external BPO. I'm going to look at the collateral files, and everything matches up. And they happy with my bid? Great. We'll wire them money, and then they'll transfer the note to us about 30 days later. If something pops up that doesn't make sense, like they give a value at 150 on the spreadsheet, but it comes back at 100. Well, I'm gonna counter my bid or reduce my bid. If they accept it, great, we'll move on. If they won't accept my bid, then I just cancel the bid and moved on to the others that I made offers on.
Yeah.
All right.
Okay.
If they come back and want some abnormal price, I'll go, why do you want that price? It doesn't make any sense. Here's, they owe $5,000 in back taxes. Here's what we found with the property value. So we'll do some upfront due diligence before we make an offer, but it doesn't make sense to spend forever on these assets because you don't know what they're going to accept. Now, sometimes they'll give you very clear pricing. Some sellers will tell you, hey, here's what we're looking for, specifically, and I can run numbers. If it makes sense, great, we'll pull the trigger. I can sometimes negotiate back a little bit with them.
Yeah.
The number one negotiation tactic, Will, is just follow up.
Right.
You know what I mean? I would say the longer a lender or bank holds on to a note, that every 90 days they get more motivated. They get really motivated at the end and the beginning of the year too.
Gotcha.
So there's been deals that I followed for 6 months, to a year till I finally got my price. Just literally yesterday, we made an offer with a California fund on a note in Orange, Texas, which is over by Florida. They didn't accept their bid. They got a little bit higher bid from somebody. I'm like, that's fine. Well, a month has gone by. I reached back at the seller. Hey, did this guy close on this deal? And they're like, oh, it looks like he's flaking. I'm like, okay.
Right.
Well, my bid is still accepted right now, provided all the numbers still the same. And so they just emailed me 5 minutes before I got on here with you. Said, yes, your bid, we'll accept your bid. How long do you need for due diligence? I said, we already did a lot of due diligence initially because it's in our backyard. I said, we can close in 7 to 10 days.
Wow.
And that's going to be a note that is worth 100. They owe 90 on it. We're picking up for 52,000.
Wow.
If the bar starts paying on time again, it's going to be about a 14% cash and cash return. If they don't, we've got a chunk of change to foreclose on and fast foreclosure in Texas.
Yeah. So is that yes, that's my next one. What's the normal discount that you're buying is that? So let's say hypothetically someone owns a property worth 100,000, the loan on it is at 80,000. And so they're just they're in default with that. So what would you normally get that at?
So when they've got some equity, if they've got a chunk of equity, 20% or more, I'm going to bid like 80 cents on the dollar balance. Okay. So on that strategy, I'd bid 56 to 60,000.
Gotcha.
56 to 64. It's 80 cents on the dollar of 80, 64,000. Right.
That's really good.
So something like that. If it was upside down, they owed 125 and a house is worth 100. I'd probably come in at 65 to 70, depending on what state it's in. But then Georgia or Texas, I'm going to have to probably come at 70, 75 cents of the dollar, depending on where it's at. If it's in a longer foreclosure state like Florida, I probably have to come in at like 50, 55 cents of the dollar.
Right.
Just because it's got that longer foreclosure time frame. So it varies a little bit different. People ask me all the time, well, what about multifamily notes? I want to buy multifamily notes. I'm going to tell you right now, everybody and their dog wants multifamily apartment loans. You're not going to get them at a discount. The banks, especially all these, we had over 1,000 units go to foreclosure in Harris County this last month across like 4 properties. The banks foreclosed and took them all back. Banks realized on those larger commercial properties, they're not going to take a haircut. They're just going to foreclose, clear the title out, and plan on holding on to them for 2 to 3 years and regentrify them, get them back up track, and then hopefully that the market changes. Then they'll sell them off at that point.
So the bread and butter with this strategy is really residential homes and
right now it is residential and then small balance commercial sub 5 million. And when I first started, I was buying a lot of multifamily loans, a 35, a 50, a 20, a 100, a 300 unit in Indianapolis from Banco Popular I bought. So it just all depends on how distressed the borrower is and the numbers behind the numbers.
Gotcha. It's a really unique strategy. I haven't heard many people doing that. So that's very cool.
It's a niche in the niche. I mean, it's been around forever. If you've got, and here's the thing, Will, everybody's already in the note business. You're already in it. If you've got a car note, a mortgage, a credit card statement, student loan debt, you owe your friend Bubba down the street $100, you're in the note space. You're just on the wrong side of the payment stream.
Right. Yeah, you're on the right side of this stuff, and it's real estate, right? So it's not going anywhere anyway. Yeah.
Exactly. I mean, that's I can do this business from anywhere. I don't need to be in my backyard. We hire servicing companies that handle the collections, the borrower outreach. If the borrower won't play ball, then we put it with a real estate attorney to handle the foreclosure.
Yeah.
So I don't have to go out. I mean, 95% of the deals that we've bought over the years, probably closer to 97%, I've never walked. We've used companies to pull BPOs, and we've looked at the numbers. We're buying at a price point that makes sense, that if there was an issue, great. That's what we pay for insurance. So if something happens and we open up that property and there's mold, or the bar got distressed and poured concrete down the toilet, which rarely happens, guess what? We have insurance to cover our assets and something like that.
Right. Okay. Yeah, nice. And to your point, I mean, you really just got to have the capital to get into this game because to your point, you're not going to take out a loan to get a new loan with this other.
Well, that's the thing. It's with everybody. You got to have
Yeah.
capital. Raising capital helps you
Yeah.
exponentially grow. And so the way it goes, I'd say, is that the lost start for most real estate investors is their inability to market a deal.
Mm-hmm.
You got to get out and talk. You got to get out and network. One of the best ways we raise capital is we just harvest list of IRA investors across the counties, and then we'll direct market to them, postcard letter campaigns, or skip trace them and reach out to them, because
Yeah.
just about everybody that has a self-directed IRA with like Equity Trust or Pensco, they're a real estate investor and they're looking for a deal they can sink their teeth into. And since it's a
Yeah.
self-directed IRA, it's got to be passive.
Right. Right. I'm curious, if anyone out there is doing like a fund kind of thing for this type of strategy?
Oh yeah, there's a variety of different mortgage funds out there that are available. Yeah, we've had that as well. Funds are great. You just have to make sure you got a lot of overhead. Once you take that money in, the VIG
Changes
is
everything. Yeah. A lot of
it changes
regulations.
everything. So we've seen people
Yeah.
like, we're just going to do a small fund for 500,000. Like, well, then your cost to
That's
set that up
stupid.
is
Yeah.
stupid.
Right.
You need to be looking at 5 million. But there's a big thing. If you've not ever raised $1 million, you're not going to be able to go raise 5 million just because you put a fund together.
Right.
You've got to still market that deal, and that's what I tell people. That's what I like about the note business is there's plenty of ways for you to buy a performing note that's making an 8 to 10% return in your IRA passively, or to invest with somebody and get an 8 to 10% return if your money's been sitting there, nonchalantly on an individual deal. I
Right.
mean, look at all the multifamily funds that are going belly up and losing
Yeah.
millions of
Especially right
dollars.
now. Yeah. Right now it's
Yeah,
hard.
I mean, so I think it makes more sense for folks to go out when I can buy 100 doors, but it's 100 notes, versus into one project. That's
Yeah.
what I've always liked. Find good deals. Don't do skinny deals. That's the way I always tell people. And so, like, we've bought notes in roughly 30 different states across the country.
It's
You
amazing.
know, I'm in Austin, Texas. I like Indiana. I like Texas. I like Florida. I like the Carolinas, Kansas, Oklahoma. I mean, we just closed on a note last week with one of our students in Oklahoma. A reverse mortgage borrower is deceased. If it goes to foreclosure next week, but sells at auction, he's going to make 40 grand. If it doesn't sell, he'll take it back and make 100 grand on the REO sale.
Jeez. That's pretty incredible. So most of these deals, are you going into it with a partner or is it kind of just
Yeah,
you?
most of the time, about 95% of what we've bought is using funding partners.
Okay. Yeah.
Yeah, we use some of our own money, but most of the time we use other people's money, because if I can make an infinite return where it's none of my own money, you can't beat infinite. You know what I
Yeah.
mean?
Yeah. That's pretty incredible. Well, Scott, I really appreciate you jumping on here and kind of sharing your strategy. A lot of great points today. Before we jump off, just got a few more questions for you. So for people listening, kind of what's the best way for them to get in contact you, reach out to you, and kind of learn more about the strategy?
Really easy. There's two ways I tell you. You can always book a phone call and go to talkwithscottcarson.com. Talkwithscottcarson.com. That'll take you directly to my calendar. You can book a phone call. And we offer up also a free 2-hour class, kind of like a dip your toes in the water. See if note investing is right for it. Just go to noteweekend.com. No credit card required. Sign up for it. It's about a 2.5 hour class where you learn the basics, how we find, fund, flip, and flow notes on deals all across the country.
Awesome. We can put those links in the comments of this episode as well. And then my last question for you is kind of what are your main goals going forward for the next few years?
Make hay while I can. My biggest mistake is I didn't buy more notes back in 2010 to
Yeah.
2012, and my goal is to buy as many notes as I possibly can. Price point's a little bit higher, but that's where it comes down to, is there's no lack of opportunity in what we're doing, no lack of deal flow if you know how to market. So just getting out there, and there's plenty of deals to go around. I think I'm one of the few that believes that with our education side of things. Like, there's plenty of deals. There's very little competition because it's a smaller niche, but there's, when you see deals 6 to 12 months ahead of your traditional fix and flippers or the foreclosure guys, the auction,
Yeah.
it beats to be direct to the source.
Yeah. You can't get better than that and a discount. Well, All right, guys, there you have it. Scott Carson, thank you so much for joining us today.
Thanks for having me, Will. And you guys that are listening, make sure you hit the subscribe button and go leave Will a 5-star review. Not 4-star, 5-star. You know he's kicking ass and taking names on this, and we as podcasters love to hear from our audience. Make sure you leave him a 5-star review and a nice comment.
Appreciate that. You're right. Reviews do go a long way for podcasts. So absolutely.
Thanks, Will.
Yeah.
If you enjoyed today's episode, make sure to follow the show so you never miss a new release. And if you want all episodes in one place, plus exclusive insights and updates, head over to willpowerpodcast.org and join the email list. Lastly, if you're listening on Spotify or Apple Podcasts, take a quick second to leave a rating. It helps the show grow more than you know. We'll see you in the next one.